we identified as the main driver of the industrial real estate. The first one is e-commerce. As of the third quarter of 2021, this industry accounted for 15% of the total national industrial space demand. And the second one is nearshoring. Industrial real estate located in the north of Mexico benefits from its closeness to the United States. So now let's take a closer look at the premises that build our whole recommendation. The first one is that Vesta is the most efficient player among its peers when it comes to operating efficiency. This is shown in superior gross and EBITDA margin. We attribute this cost efficiency that comes from two sources. The first one is that almost 90% of Vesta leasing contracts are denominated in US dollars, whereas its expenses, such as property tax, insurance, and maintenance, are incurred in Mexican pesos. And the second one is Vesta's construction and development model, in which suppliers have to compete in order to develop Vesta's project. This gives the company bargaining power, allowing it to develop at optimal cost and conditions. So taking this into account, in our forecast, we expect that Vesta's gross margin and EBITDA margin to be around 95% and 86.4% between 2021 to 2026.
Now, you might be wondering why we issue a whole recommendation if Vesta has this advantage over its peers. Well, this takes us to our second premise. Vesta is missing growth opportunities. We reiterate our whole recommendation based on the fact that Vesta's advantages and differentiators are not reflected on its current performance. Let's see this. Since Vesta is not a fibra, it should have a superior ability to take on growth opportunities because it has more investment freedom than its competitors, given that Vesta doesn't have to distribute the distributions that we talked about earlier. However, as we can see, Vesta has been growing at a slower rate than its competitors in emerging markets such as the metropolitan area and north of Mexico. Now, let's look at a revenue driver. Vesta's performance in occupancy rates has been below its peers. This raises concerns about Vesta's ability to retain existing clients and attract new ones. If we take a look into Vesta's financial performance, we can see that it is a company with solid revenue growth. However, its net income was highly volatile between 2016 to 2020, and our analysis showed that there's not a clear correlation between its net income or cash flow from operating activities nor operating income. This questions Vesta's earnings quality, as net income does not seem to be a reliable indicator of Vesta's financial performance. Now, Eduardo is about to show us how constructing Vesta's objectives and results are.
Vesta has failed to meet its annual growth and investment objectives set in its Level 3 strategy, which aims to expand its presence in growing markets. The mismatch between actual and aimed growth raises concerns about Vesta's ability to incorporate its advantages to its performance. That's why we encourage investors to hold Vesta's shares through the end of 2022. But how does underinvesting affect Vesta's value? Well, this affects Vesta's GLA growth, for which we have forecasted an annual increase of 2.5 million square feet for the next 5 years. This matters for the future because a conservative forecast in GLA means a conservative forecast in revenues. And we sum all our analysis up into our target price of $1.98. Now, let's see how we construct this number. We built our target price based on the weighted average of the prices implied by several valuation methods. First, we assign 60% weight to our free cash flow analysis. This model allows to incorporate both macroeconomic and Vesta's internal factors, as well as conducting a scenario analysis. In our base case scenario, we arrived at a price of $1.91, and we double-checked our results by conducting a sensitivity analysis. Then we assigned 30% weight to the different discount model. Here, we estimated a price of $2.25, and the final 10% comes from benchmarking using relative valuation. Here, we estimated a price of $1.51. Finally, we run a Monte Carlo simulation, and the median price of $202 supports our whole recommendation and tests the reliability of our target price. And once we know these figures, what's next holding? Well, if Vesta gets to achieve its set goals by the end of 2022, we will recommend investors to buy, given that under this scenario, we are expecting a target price of $2.43 by the end of 2023, representing a potential upside of 23% with respect to our 2022 target price. But in the meantime, we believe that waiting is a good idea, given that Vesta is increasing dividend returns to shareholders. So far, we have seen lots of numbers, and now Mike is going to talk us about other issues that are also really important.
Environmental, social, and governance issues are more and more important every single day, and Vesta understands this. As such, the company makes huge effort in communicating their ESG initiatives to investors and stakeholders. However, digging further into the company's records, there is a mismatch between the company's ESG claims and action. For example, earlier this year, Vesta issued $350 million in sustainability-linked bonds. This hold the company to a set of principles and guidelines it should follow in order to maintain the ecosystem. However, there is one step in Vesta's value chain, construction, that it outsources. And as such, the company is not held responsible for the pollution this may cause. Similarly, the company claims to be very worried about inclusion and diversity. However, taking a look at this, we can see that 100% of its board of directors is made up of male directors with no female directors on the board. As we go lower down the command chain in the C-suite and manager levels, we can see the gender gap start to close. However, there is still less than 30% female employees hired by Vesta on these levels. Only as we reach level 4, administratives, we can see the gender bridge flip and get closer to a 50-50 split. We can see that based on these examples, Vesta talks a lot about ESG and may care a lot about communicating it, but it still has ways to go to fully embrace these goals. If Vesta fails to meet these ESG claims, it may bear reputational risk. Other important risks Vesta faces are its debt levels, which will have risen above the company's own debt cap objective. While there is not still signs of financial distress in the company, it is important to note that huge amounts of cash have come through the company this way, and it still has failed to meet its investment and CapEx objectives, while still paying dividends as high as 95% of its net income in the past year. Other important risks Vesta faces are the decrease in foreign direct investment, as most of its clients are multinational companies, increasing the interest rate, and the performance of its tenants, such as with the automotive industry, which is an important part of Vesta's portfolio of clients, and which suffered greatly during the 2020 COVID-19 pandemic. So, once again, having seen investment risk, ESG claims, and having gone through our valuation, we once again remind you that investors should hold Vesta stock because its superior operating efficiency makes it attractive to its clients, but it has missed growth opportunities while failing to meet its own CapEx goals. But satisfying dividend returns may hold over investors as we await for more information. Once again, we reiterate our target price of $1.98 with a potential upside of 7.81%. Thank you very much, and we will now take your questions.
Hi, let me start. Can you hear me well?
Yes.
Yes.
Okay. What do you think is different about Vesta versus the others? I mean, you mentioned it as the black sheep in the industry. I mean, they've done a good job in growing assets and delivering returns to shareholders. I mean, I understand your concerns, but the reshoring trends and the e-commerce and the logistics are so powerful, and probably even despite a scenario where interest rates are going up, these kind of assets could be a good investment in this environment. Don't you think so?
Yes, I think that Vesta is different in its clients, with respect to its competitors. Firstly, because as we've said, the FIBRA's difference make it have different kinds of growth opportunities. FIBRAs are limited in the amount of GLA and CapEx investments they can make year on year, while Vesta is not. Another important thing that makes Vesta difference, I think, would be its portfolio distribution. Vesta's GLA, while still being behind other companies in absolute terms regionally, it is still the highest with respect to its competitors percentually in the Bahia region, which, as we've said, is a growing market. So I think those two factors would make Vesta a little different than its clients in respect that it's able to grow at a faster pace, and it has more important property in the Bahia region.
Okay, thank you.
I have a question as well. I don't know if somebody was gonna ask something.
Please move ahead, Aris.
All right. So what you mentioned that the company is far from achieving the gross leasable areas expected growth according to their 3-level strategy plan. What actions do you think the company has to take in order to get close to its goal? And under which circumstances would you change your recommendation to buy?
Yeah, I can take that. We believe that the company is following its level 3 strategy on returning more return to its investors. However, our analysis showed that investors will be better off if the company takes that money in order to invest more in CapEx to achieve its goals and remain the dividends at the level they are. And in order to change our recommendation, we would need a 3 million growth in GLA, which is 500,000 square feet greater than our expectations. Did that answer your question?
Yes, thank you.
You're welcome.
Yes, hi. And one of the key points is that when you compare this type of stock to the fibras, what we are seeing is that the growth per share of this company is higher, is doing a faster pace than fibra. And the second point is that the company, in some way, the occupancy rate has not been high. And so when you see both seen together, when you compare fibras and you compare with this type of company, which is not a fibra, what are your thoughts in terms of the growth we have here and the growth we have in fibras?
I think an important factor in why fibras are have a higher rate is, we can explain here, the northern region and the central region are still are the most developed ones, so they have a higher, they are more competitive, as we can see the occupancy rates in all of the different columns, and where the revenues come from. So I think, as I mentioned previously, fibras are more centered in the north and center regions of Mexico, while Vesta is more centered in the Bajío. So while it can grow there, the region is still not as developed as the other two, and that might be a big difference.
Adding to that, we find that the movement of the price increases when in 2019, when level 3 strategy announced. Also, we think that there was more expectation of Vestas, because Vesta is not limited as fibras with their growth. And also they are not obligated to pay the 95 of the tax thresholds in dividends. So they can use e-commerce and nearshoring to increase their growth. And also, if Vestas achieve those targets in best level 3 strategy, we issue a buy recommendation. So the market know that Vestas can achieve that goal, because it's not obligated to make this legal distribution that fibras need to do.
Thank you.
I have one question here. I don't know if someone else has one, but in terms of the supply chain for the automotive industry, I don't know what is your expectation of a possible impact on this industry. How could it affect the investors in Vesta?
Yeah, I can take that. We consider the total growth in automotive production when we were forecasting our revenues, and we saw that there was a positive correlation between, in general, occupancy rates in the market, specifically in the Bajío region. And so, if this industry decreases its production, that could hurt Vesta's revenues.
Thank you.
I have a real question. Relying the automotive consumption, let's say, for example, we've been hearing a lot that mainly the automotive, in this case, the automotive industry is having a decrease within their sales and their net income. Is that going to affect, for example, in this case, the valuation, or let's say the income expectation within Vesta?
Yeah, I can also take that. Yes, indeed, it will affect Vesta's valuation. However, we are really confident about our results and assumptions, given that we did a scenario analysis in which we were varying all these variables. And here, as you can see, we did three different scenarios, and we believe that that Vesta, that our final numbers are really strong.
Thank you.
So if you don't like Vesta that much, do you have any sense of which of the fibras or an equivalent real estate company you would be putting your money on instead?
I can take that. Yes, I think that a really important fibra right now is Fibra Prologis, as it has a strong presence in the north and metropolitan areas of Mexico, as 7% of its portfolio is in the metropolitan area. The other 30% is in the northern, and these two regions are having a exponential growth with e-commerce and nearshoring, and also 11% of the portfolio of Prologis is in e-commerce and logistics. So it has a very strong position in these emerging markets.
Okay, and valuation-wise, do you know if Prologis is more attractive than Vesta?
Prologis has occupancy rates that are higher than Vesta. Its cap rate is very similar to the industry, such as Vesta, and it has performed well in the market.
Okay, thank you.
You're welcome.
Un minuto si alguien quiere hacer una última pregunta.
Yes, this is about ESG. You put a lot of emphasis in gender issues. Beyond that, do you have any comment in terms of a smart building, of other things that could be affecting the ESG case?
Yes, to go quickly about some ESG issues. Well, some ESG points. The company's board is made up of mostly independent directors.
Sorry. Beyond governance.
Excuse me?
Beyond governance, you have any comment in terms of much more?
Okay, yeah. Vesta spends some money in social investment. It gives 1 US cent per GLA built, and it does some work in the education, inclusion, and community development fronts. In total, it spent 3 million Mexican pesos last year.
Tiempo. Pues creo que just in time. Chicos, muchísimas gracias. Muy buen trabajo. Les agradezco mucho y pues nos vemos en un ratito para los resultados.
Muchas gracias.
Estaremos pendientes.
Gracias a todos.
Gracias y felicidades por llegar hasta acá.
Muchas gracias.
Felicitaciones.
Fantastic team.
And me, Olga. And we are from Anáhuac, México Norte. Are you looking to transform the industrial real estate sector in Mexico while earning excellent returns? We recommend you to invest in Vesta. We are issuing a buy recommendation with a target price of 43 pesos, representing an upside of 16% from its closing price of November 12, 2021. Now, to explain this board recommendation, let's now understand the operations behind Vesta.
Corporación Inmobiliaria Vesta is a Mexican company dedicated to the acquisition, administration, sale, development, and redevelopment of properties for the industrial sector in Mexico. Having a presence in 15 states of the country with a portfolio of 189 buildings distributed into the regions. It has 31.6 million square feet of gross leasable area. Vesta has been listed on the Mexican Stock Exchange since 2012. Most of Vesta's clients belong to the manufacturing sector, and the remaining belong to the logistics sector. Most of the foreign direct investment of the country is in the manufacturing sector, especially in the automotive industry. 34.7% of Vesta lease area belongs to this industry, to this industrial sector. The industrial real estate market has been enhanced by growing demand. Most of the demand for industrial and logistic spaces is due to the growth of e-commerce businesses in metropolitan areas and by TMEC in border areas, where BTS projects predominate, which are constantly demanded by manufacturing companies. A 22% growth is expected. Vesta direct competition is mostly comprised of Mexican rates. Compared to them, Vesta has had the best stock performance in the last 3 years. Vesta has demonstrated great resilience, being the fastest recovering company in its sector in the country. In terms of operating performance, Vesta has topped all of the direct competition, having a gross margin of over 93% in the last 4 years.
Now, what differentiates from their peers? Vesta operates in strategic markets with high demand and potential growth. It offers innovative, high specification, and high quality real estate solutions tailored to the needs of their clients under eco-efficient standards that encourage their development. Vesta seeks and prioritizes the creation and generation of value, the decrease of risks, the strengthening of the balance sheet, the solid financing sources, and the optimization of resources to maintain and improve the current portfolio aligned to the ESG aspects.
Their ESG policies fall in accordance with the Code of Best Corporate Governance Practices of the CCE. According to their own materiality study, which aims to identify key ESG risks and opportunities, the most important topic for their related interest groups is client satisfaction, while for Vesta, it is energetic management. Vesta has more than doubled their S&P ESG score in the past few years, while their peers remain in the same levels. In environmental matters, Vesta issued their first international green bond this year, gathering over $350 million for green projects. Their sustainable construction manual ensures that all new projects are built responsibly. They already have 12 LEED certifications, and the company voluntarily presents an environmental report in line with the TCFD. They developed 2 ethics codes, one internal and one external, with all complaints processed by Ethics Global. This ensures that both collaborators and suppliers comply with the ESG policies of the company. In 2019, they got certified as a great place to work. Their current social investment policy is to invest $1 per every rented, constructed, or managed square meter. Their social investment soared in 2020, mostly due to pandemic-related activities. Their board of directors is mostly comprised of independent members, with 2 of the 6 aiding committees completely dedicated to ethics and ESG matters. Vesta has over 80% of floating stock, with 0 non-controlling participation, which warrants a fair governance. They have also been awarded numerous ESG recognitions, including multiple prizes for Best CFO and Best ESG.
Like any other company, Vesta faces many risks. Among the most significant are the inflation and the changes in the interest and exchange rates, as well as the crime rates in the states where Vesta has presence. However, the company has proved to have excellent risk management and prevention policies.
Talking about historical growth of the company, their sales have been growing steadily for the last 6 years. The amount has risen from 109 million in 2017 to 149 in 2020. This represents a compound annual growth rate of 11.1% between those years.
Our forecast predicts that Vesta will reach 187 millions in 2023. The GLA remained practically the same during 2018 and 19. For 2020, it experienced a slight increase. It is noteworthy that since 2017, Vesta has maintained its occupancy rate above 90%. Vesta has not only great total revenue numbers, but also a solid gross.
Hello.
Sergio, creo que te atoraste.
Lo sacó.
Si alguien puede continuar porque el tiempo, si quieren ahorita regresamos a esta parte.
Ok, sí.
Sí, si quieres vete a mi parte, Olga.
Bueno.
Okay, now, to estimate the target price, two different valuation techniques were applied. DCFC model and EV/EBITDA ratio using comparable companies. Our estimated price was determined by the weighted results of these two methods, with a 70 and 30% proportion respectively. EV/EBITDA multiples method was used as a relative measure calculated from a group of local peers. Industry median was 11.8. We estimated an average sales growth of 8.8%, giving us an EBITDA of 148. Using this method, we obtain a target price of 33.11 pesos with a negative variation of 10.4%. When multiplying it with its proportion, we obtain the figure of 9.9 pesos. For the DCFC, we use the following inputs: WACC, based on Vesta's capital structure and company's risk, mainly due to their sales. Vesta's cost of debt is 3.5%, while its cost of equity rises to 11.3%, generating a WACC of 8.2% with an exit multiple of 2,568. Using this technique, we obtain a target price of 47.4 pesos, having a positive variation of 28.2%. When multiplying the number with 70% proportion, we obtain the figure of 33.16 pesos. Furthermore, to complement our research, we ran a simulation based on Monte Carlo analysis, considering different levels of GLA and square feet total occupancy to revenues. The outcomes were classified in three scenarios. One, the pessimistic scenario, considering a GLA under 90.8% and a square feet total occupancy to revenues of under $5.1 per square feet, obtaining an average price of 40 pesos with an occurrence probability of 34%. Two, the conservative scenario, based on a range of 90.8 to 91.4% GLA and $5.1 to $5.2 per square feet, estimating an average price of 45 pesos with an occurrence probability of 52.1%. And three, the optimistic scenario, where the average of both value drivers are over 91.4% and $5.2 respectively, delivering a stock price of 48 pesos with an occurrence probability of 13.8%. Our target price falls in the range of the conservative scenario. Given our thorough research and analysis, we reiterate our well-founded buy recommendation with a target price of 43.09 pesos and a 16.62% upside. Sergio, I don't know if you want to continue to your part.
Yeah, I'm sorry about the technical issues. But well, I was remarking that total revenues have been growing steadily. And of course, it is due in part of the GLA that has also been growing, not in excess, but steadily. And well, okay, talking about the gross margin, it is remarkable also that is quite superior compared to its competitors one. And well, talking about the EBITDA, this variable has also been solid. It has been growing during years. It grew very fast during the years 2016 to 18, and then it went a little bit down. I mean the growing rate, but nevertheless, it has been growing year by year.
Tiempo.
Yeah.
Okay, thank you very much.
Okay. Pasamos a las preguntas y respuestas. Adelante, pues.
I can jump, if that's okay.
Yes.
Thank you. Thank you for the presentation. I was wondering if you have considered the recent news regarding the subsidies that could be granted to electric car manufacturers that are assembled in the US. And, this would really impact the automotive industry. What do you think that this could impact have on Vestas customers and conditions? And what other main drivers could lead to a change on your recommendation? Thank you.
Okay, I'll take this one. Yes, we have considered that alternative, and we do believe that it may have an impact on Vestas performance overall. However, we do believe that Vestas has contracts for many years with said enterprises about the automotive sector. So we do believe that gives them some assurance that they will still perform for several years. And also we believe that the inflation may have an impact because of the increase on the cost of materials. But however, we also think that they do have sufficient resources to maintain and to negotiate with their providers.
Thank you so much.
Along those lines, you mentioned in your report that you think that they should be able to constantly negotiate prices above inflation, and you just mentioned something around those lines. But I mean, inflation in Mexico this year is going to end at around 8% or high 7%. I mean, do you really think they can keep on putting pressure on their clients in terms of pricing? And the dollar has been moving, of course. So most of their revenues come from dollars or are dollar-based. I mean, it is a tough environment to put further pressure on clients who may be having issues already. So how comfortable are you that they will continue to do that going forward?
Okay, I'll take that one too. Or anyone else wants to answer that?
Well, they are covered with derivative options against the adverse changes in the exchange rate. And as for inflation, according to the expectations of the experts in economic sectors, in the survey made by Banxico, they all expect that the inflation is transitory and it will go back to normal levels as soon as the new year begins.
Okay, thank you.
Vestas has a lot of cash in its balance sheet. What do you think is the best strategy for moving forward in the next couple of years?
I'm sorry, could you please rephrase the question?
Yes. Vestas has a lot of cash in the balance sheet. How do you think they plan to invest that, and if you think that they can commit or execute in reasonable time?
Okay, Vesta has positive working capitals since 2016. So I think that they feel safe when having more current assets than current liabilities. And it also reflects, of course, a good sign for the investors. So I think it has to do with what you're saying of that they like to have a lot of cash. It is also worth mentioning that, for example, they have an interest cover ratio very superior compared to its peers.
Thank you.
Are you concerned with the high level of indebtedness of the company?
No, no. In fact, no. I mean, I'm really sorry about the technical issues that I had, but I was about to explain that the interest coverage ratio has been just better every year of the past 5 compared to enterprises on the same sector. So it is not a concern. In every metric you evaluate about Vesta in terms of capability of paying their debts, they are completely fine. And I also was about to mention that the total liabilities have increased not only in nominal terms, but also respectively to the total revenues. But nevertheless, that is not a concern for Vesta. Absolutely not.
Okay, thank you.
What do you think of the earning quality of Vesta?
I'm sorry, we couldn't hear you, the question.
What do you think of the earning quality of Vesta?
I wasn't able to understand the question. I'm sorry.
Yes, what do you think of the earning quality of
The
of
earning
the Vesta? Earning quality. Earning quality is when you know how predictable they are along the years and according to their activities.
You asking, excuse me, I didn't hear you. But you're asking about the EBIT?
Yes, the quality of the earnings, if it is good or not, and how predictable are the earnings?
Okay, I will check this one. If I heard correctly, it was about the earning quality, and as Vesta's numbers says, they have been very predictable. They have been increasing year by year, and even though the pandemic came through, Vesta still had great numbers. And if the pandemic, which is one of the worst scenarios that can happen in the world to many businesses, this wasn't a problem for Vesta because its main clients have been increasing revenues. So said that, we believe that Vesta is in a good position to keep having great earnings, and we do believe that they are predictable, and that is why we also issue a buy recommendation.
I would like to add something, and it is that there are 3 metrics that have increased throughout the pandemic and continuously in the past 6 years, and that is total assets, revenues, and also EBIT. EBIT has been steady. So those 3 variables make a very promising scenario for Vesta in the upcoming years.
Thank you.
Un minuto, ¿alguna última pregunta?
What concerns you the most, this company?
I think right now the main concern can be the inflation that is going in a rise, and also the TMEC policies that the US government just said. I think that these 2 are the main key risks right now.
Okay, thank you. Maybe Vanessa and Manuel want to ask something as well.
Very good, Hector. Thank you a lot.
Well, I just was wondering if you know the approach of Vesta in terms of the new normality, right, with this pandemic situation, if they are taking a different approach from the real estate industry, or basically that is the question.
Well, Vesta has been recovering very well after this pandemic, and thanks to
thanks to the pandemic, trends like e-commerce has been improving logistics sectors. So this is so favorable for Vesta because its demand is growing, and their industrial buildings has been increased for the demand and metropolitan areas firstly.
Tiempo, chavo. Ya.
What?
Disculpa. Tiempo.
Okay.
Gracias.
Perfecto, no. Oigan, chavos, pues muchísimas gracias. Todo muy bien. No se preocupen por los detalles técnicos. Pues les agradezco mucho y nos vemos en un ratito para los resultados. ¿Va?
Que sí, muchísimas gracias a todos.
Thank you for hearing everyone. Muchas gracias. Una disculpa por los problemas técnicos.
No se preocupen.
No problem at all. Thank you.
Buenas tardes, se me escucha. Una disculpa, no desconozco el problema con la reunión.
Sí, podemos empezar.
¿Me pueden ver?
Sí, podemos empezar, por favor.
Vale. Cuando ustedes me lo indiquen.
Ya.
Vesta, a leading provider on the industrial real estate for national and multinational companies in Mexico, facing multiple challenges as well as taking advantage of new opportunities. Welcome everyone. We are the team representing Universidad Anáhuac México Sur, and this is our presentation of Vesta's professional research about the company, its industry overview, ESG scores, financial analysis, and valuation. After doing all this task, we can say that our investment recommendation is to buy, with a target price of $2 at the end of the year, meaning almost an 11% upside regarding the initial price in November the 12th. The Mexican industrial real estate sector has been growing over the last few years at a 5.4 compound annual growth rate since 2015. Much better compared against other Latin American countries, and with growing projections in the future, especially with the trending of the e-commerce as a key driver. This subsector has various competitors, but is clearly dominated by 5 top companies, including Vesta. The other 4 are real estate investment trusts, well known in Mexico as fibras. This industry has been very resilient, and despite pandemic, it has managed to have a net demand increase by 6.4%. All these factors made this sector a really good investment considering the global environment. Let's talk about Vesta's unique business model, which is powered by above average ESG practices and the fact that Vesta is the only leader in Mexico that is not a REIT, giving the company more flexibility in both investment and dividend policies. Furthermore, its advantageous geographic location that is exploring the nearshoring effect with USA thanks to ETIMEC has enabled the company to be not highly affected by the COVID-19 pandemic.
Vesta has a portfolio of 181 clients in 11 different industries, diversified across the 3 areas with the highest growing economy in the nation. Vesta is covered for the following years because 91% of its technical revenues remain until 2024. For the company, environmental, social, and governance are part of its core business. For this reason, these 3 points are necessary to grow, bring capital, and have a sustainable business model over time. Since 2017, Vesta aligned itself with the Sustainable Development Goals. Vesta's efforts have given them, for the 2nd consecutive year, a place in the S&P DMV Mexico Total ESG Index. They consider that developing sustainable buildings are necessary to continue in the market and give us them surplus value. In Latin America, Vesta is the first industrial real estate company to issue an ESG-linked bond, This allowed the company to obtain resources to refinance its debt. In 2020, Vesta supports 11 projects related to COVID-19. Additionally, investment in social projects focus on education, inclusion, and community development. In corporate governance, the board has 10 members, from which 8 are independent directors with experience in industrial real estate, business, and finance. But 90% of it is represented by men. This could be an area of opportunity to diversify the board and improve the gender equality. The above supports the S&P Global ESG score of the company far higher than the industry average.
Among Vesta investment risks, we classified each depending on their probability and impact. Our biggest concern here is having low levels of occupancy in case the inflation rate heavily rises, a long and unexpected depreciation of the Mexican peso against the US dollar, given that, according to Vesta's last report, approximately 84% of its income was made in dollars, and the possibility of a dissolution or renegotiation of the TIMEC, which could heavily impair Vesta's operations. We need to also have in mind the constitutional initiative for energy teams, which it is speculated to negatively impact on the credit ratings, in addition to Vesta's financial risk of fulfilling its cash necessities throughout debt or equity, the risk and crime and insecurity in roads mainly caused by drug cartels located in the Mexican border, and the pandemic sanitary measures that have recently emerged. Now, on the other hand, Vesta's current opportunities are the increasing participation in the e-commerce by building new parks in the most important metropolis in Mexico, such as Mexico City and Guadalajara, the nearshoring effect within the e-commerce with USA, and Vesta's strive to be known as an industry benchmark in ESG. For which, since 2019, Vesta's Level 3 growth plan seeks to generate value while strengthening the organization. This business strategy aims to raise its capex from approximately $120 million per year to $200 million. And by 2024, Vesta plans to recycle up to $300 million in property value, increase their gross leasable area up to 40.8 million square feet, and to have a $0.2 FFO per share and a $3 net asset value per share.
In 2015, Vesta Vision 2020 was implemented with the purpose of duplicating Vesta GLA by the end of 2020. Also, since 2017, net asset value has risen due to a company consistency in creating and developing new industrial parks at cap rates above 10%. Due to e-commerce, industrial real estate has emerged stronger from the pandemic. As an example, Vesta's NAV increased 25% in the first 9 months of 2021. Because of the nearshoring effect, the north zone demand per square foot is significantly above the other zones. Therefore, we consider this could be an investment opportunity for Vesta. This type of industry does not consider depreciation for the buildings, only for the office equipment. And because administrative expenses have been wisely managed, both EBITDA and NOI margins have been relatively constant the last years, except in 2020 due to an increase in the bad debt reserve. Debt to equity ratio reflects the company has been financing its growth mainly with debt. Return on equity has followed the tendency of net income, as equity has been growing modestly because of the latter. Debt to EBITDA tends to be higher in real estate industry due to the high levels of debt of acquiring land and building. Vesta carries over the debt at maintaining a loan to value below 40% and obtaining debt at low interest rates. Meanwhile, interest coverage decreased in 2018, remaining constant for the last 3 years. Although Vesta is not a rate, it uses FFO, which is a non-GAAP metric focused on the specific operation of industrial real estate. For the last 5 years, operating FFO pre-tax has increased constantly, and if this tendency is maintained, Vesta will likely reach 20 cents FFO per share by the end of 2024 as expected.
Our team's valuation consisted of a weighted average of 5 methodologies. This was obtained in US dollars as most of Vesta's income and all of its debt is in this currency. 2 of the methods used are FFO-based, to consider Vesta's specific operations excluding non-cash accounts. For the discounted cash flow and discounted funds from operation, a WACC of 7.10% was used. DCF was made through a 3-stage model. The assumptions made are consistent with Vesta's Level 3 strategy. Also, today's capital structure is expected to hold. For the FFO is a commonly accepted metric given by Nareit for industrial real estate companies that can reflect its earnings performance. The traditional DDM regarding net income was used, but also a DDM regarding FFO is proposed, as the dividend payout ratio seems to have a closer relation towards FFO. For multiples valuation, two groups of peers was considered, as Vesta's business model best suits Latin American companies, while its location makes it comparable to the most important Mexican rates. The multiples considered were chosen based on a regression made for Vesta and its peers, which showed that ROE for the industry highly depends on EBITDA and net income margins. Vesta is an industrial real estate company with a unique position in the market due to an advantageous location, ESG practices above the average of the industry, flexibility towards dividends policy, and resilience to face uncertainty. Therefore, a promising future awaits for Vesta as they keep developing their strategic plan to gain value. So we consider Vesta a certain buy for an uncertain future. Thank you very much.
Muy bien, muchas gracias. Pasamos ahora a la sesión de preguntas y respuestas. Adelante.
I have one question. Did you consider U.S. peers in the sample to compare Vesta? I mean, I saw a couple of Latin countries, but given the closeness of the U.S. and Mexico and the USMCA and all the flows and the economic integration, wouldn't it make sense to compare it to U.S. peers as well?
Well, we consider these two groups of peers because the nearshoring effect that can be used from Mexico, it can be also used from USA. However, the economy, we believe it is not well comparable from Mexico to USA. So we believe that it was a better, closer relation with the peers from Brazil, mainly because the industry in the industrial real estate seems to have an operation that is more similar to Vesta's.
Okay, imagine you could have used the US and just apply a discount to Vesta versus US peers, but that's fine, thank you.
Why do you call a certain buy for an uncertain future? You know, could you elaborate a little bit more on that?
Vesta future, we believe Vesta is a certain buy because its strategy is strong. They are growing and they are planning to buy new land and new buildings to make more value to everything. Also, we believe it's an uncertain future because the administration nowadays is not too clear of where it's headed. There are many macroeconomics variables that are uncertain nowadays, as is inflation, interest rates. We believe Vesta is a certain buy.
Thank you. Just one more comment. Don't you think that nearshoring, reshoring, and all the industrial powerful sector that has Mexico could provide much more certainty about what is the future of the company?
Well, most of Vesta's tenants are certainly going for approach to send their products to USA, and there is a strong commercial partner in Mexico for the United States. This has been going on for several decades so far. So we believe that this effect will maintain in the future. So although the administration, as Mariana said, is unclear, we believe that Vesta can outcome this uncertainty.
Thank you.
Thank you. How do you measure your liquidity? I mean, how would liquidity risk and high interest payment affect your model?
Well, that's a good question. First of all, we have to mention about Vesta's debt, which is something that the company has to be aware of. Currently, its level, it's quite normal because this industry, the real estate, has high levels of debt. Debt to EBITDA margins, for example, are much higher than other industries. And currently, its cost of debt is around 4.48%, with maturity of 7 years, around 7 years. And well, that's something that Vesta has to be aware of to be prepared if to be applying all the payments, all the interest payments in the right times. But fortunately, we believe that Vesta's capital structure and debt strategy is going okay nowadays, and we believe that that will perform in the future as well.
Thank you.
Obviously, the pandemic scenario that we just that we're witnessing has helped these kind of companies through e-commerce and logistics, etc. But how far do you think that can go? In other words, where is the top? Because in other countries, even China, the US, the UK, etc., I mean, there's a certain threshold that probably there's a limit as to how much e-commerce can grow. How do you see Mexico? And obviously, this period has advanced the penetration overall, but where do you see the potential to continue penetrating, and how would that impact Vesta if there is a limit that could be lower than many people think?
Well, e-commerce is a key driver, and it was powered by pandemic. That's true, but we believe that e-commerce came to remain for the future. For example, some INEGI perspective for this year is that e-commerce activities, related activities, will represent 9% of the gross domestic product of this year. So if this situation increases, all the logistic and e-commerce activities will represent an advantage for all the real estate industrial. So that's why we believe that Vesta has to try to increase its margin of companies that are involved in these sectors to be okay with that.
Yes. Also, I believe not long ago, Vesta invested 15 millions in Mercado Libre in a new building. Also to increase this logistic and e-commerce part. And there was a very good location because it was too close to the airport of Guadalajara, which is the second biggest airport and the most important, well, the second most important. So we believe Vesta is also seeing to the future, also trying to increase this part because he knows there's a future for it.
Thank you. How much pricing power do you think they have, considering that the inflation rate has been running very high recently? I mean, the latest print in November was 7 point something, and it may end the year around those levels. And they have dollar revenues, of course, and they try to keep on pushing higher. But I mean, do you really think they can deliver further on pricing for the business, given this inflationary environment?
Well, as long as 91% of their contracts are up to 2024, And if the tenant wants to get out of the contract, has to pay the rents that are ahead. So we believe that this is not a problem in the short run. However, we are aware that the inflation rate has gone too far, too highly. And although it may affect the new tenants' capability of acquiring new tenants, we see this as a little problem for Vesta in this sense. Also, we consider a target inflation rate in the long run of 3%. And we did a sensibility analysis where we considered 1% or until a 5% inflation rate, for the discounted cash flow price.
Okay, thank you.
¿Alguien quiere hacer una última de volada o no cerramos?
Yes, I want to make a really quick question. Are you considering either in the relative valuation or in the pure analysis some sort of NAV calculation or something to measure more or less the impact on the positive gains in the terms of the values of the assets?
Well, the assets, the gain on assets are taken into consideration for the discounted cash flows and the dividends discounted model regarding net income, as net income has all of the exchange rate gains, also the appreciation from assets. However, we took FFO into consideration also because it considers just the operation, excluding these non-cash accounts. So we consider this valuation as okay for the company's situation that includes also these appreciations.
Tiempo.
Thanks a lot.
Gracias. Pues listo, chavos. Muchas gracias. Buen trabajo. Nos vemos ahorita en la sala principal, ¿vale?
Gracias.
Gracias, suerte.